In today's video, I'm going over mortgage insurance, understanding mortgage insurance, what home buyers need to know, why you shouldn't be afraid of it, why it's better than ever, and more facts about mortgage insurance. Stay tuned. All right, Matt, the Mortgage Guy, powered by You Mortgage, licensed in 48 states. To get started with me and my team, greatmortgagebroker.com. In today's video, I want to talk about mortgage insurance. A lot of people have misconceptions about mortgage insurance. They don't understand it, or they looked at it 5 or 6 years ago and thinks it's the same today as it was back then. I can tell you with absolute certainty, it is not. Mortgage insurance is cheaper than ever. It's a great option. And anybody who tells you got to put 20% down to buy a home today is out of their mind. Let's get started. What is mortgage insurance, right? If you put down less than 20% on a conventional loan, barring any lender paid mortgage insurance or specialty products, you're going to pay a mortgage insurance premium, which is added monthly fee to offset the risk of a smaller down payment. If you do an FHA loan, you're going to have mortgage insurance no matter how much you put down. It's a monthly premium. And without going into super detail, on the conventional side, and I'll get into this later, depending on how much you put down in your credit score, that mortgage insurance premium is going to vary. With FHA, it's a little bit simpler and straightforward. You're going to pay 0.55% of the loan amount spread out over 12 months, on a monthly basis in monthly mortgage insurance, as long as an upfront mortgage insurance premium FHA. But that's kind of the gist of it, right? It protects lenders against defaults on the loan by giving them this little insurance payment, right? You put down 3% on the loan, that, generally speaking, whether you like it or not, creates a higher default rate on the loan. And so you pay this little insurance because you've got 97% of the bank's money at stake and only 3% of your own, right? Little monthly mortgage insurance, right? It's typically required for all FHA loans and then conventional with less than 20% down. So those are the two scenarios where you're going to pay mortgage insurance, right? Conventional, less than 20% down. FHA, no matter how much you put down, and FHA is going to have 1.75% as of this video as an upfront mortgage insurance premium, and then that monthly mortgage insurance premium of 0.55%. So factors that will affect how much mortgage insurance you pay, like I said, the loan to value ratio, which is just how much do you put down. If you put down 3%, you've got an LTV or loan to value ratio of 97%. If you put down 5, 95% LTV. Put down 10%, 90% LTV. That's just how much of the bank's money is going into the deal, right? And so, as you would imagine, the more money you put down, the lower the loan to value, the less at risk for the bank, the lower you're going to pay in mortgage insurance. That applies to conventional loans. On FHA loans, you're going to pay that same 0.55 no matter how much you put down. Also a factor in how much it is on a monthly basis is your credit score. If you've got an 800 credit score, your mortgage insurance premium is less than if you've got a 620 credit score, right? And so 620 credit score, 3% down, expect to pay a big mortgage insurance premium. 800 credit score, 10% or 15% down, that might be next to nothing, $22 a month, $33 a month, something like that, depending on the loan size, right? Loan size, credit score, and LTV. Those are the factors that are going to decide how much you pay in mortgage insurance. Is it very important for me to inject here? Mortgage insurance premiums have come down dramatically over the last, let's call it 5 to 7 years. Back in 2015, 17, and 18, when I was writing loans, if you put down 5% or 3%, on a conventional loan, even with great credit, you were paying hundreds of dollars per month in mortgage insurance. I can tell you that 5% down, great credit clients of mine are paying $43 a month, $52 a month. Again, it depends on the loan size, but very small mortgage insurance premiums where it pays to look at putting 5 and 10% down as opposed to 20, even if you have the 20% down. Gone are the days where you've got to put 20% down because if you don't, you're going to pay $3,500 a year in mortgage insurance and you don't want to throw that money away, right? Mortgage insurance is so affordable nowadays that you probably want to look at the inverse. I've got 20% to put down, but what if I put down 5? What if I put down 10%? Stay in this loan for 3 years or so before I refinance or remove mortgage insurance. What can I do with this capital I saved up front? Either have an emergency fund, invest it in, rehabbing the home or something else, right? So that is something that has changed and you got to be aware of it. The payment options for mortgage insurance, while there are other ways of doing it, there's lender paid mortgage insurance, borrower paid mortgage insurance. You can pay it upfront, you can pay it monthly. Generally speaking, the best way to structure it is just a monthly paid mortgage insurance. In an environment like we're in today, where mortgage rates are expected to be lower in the next 12, 24, 36 months, I wouldn't encourage anybody to pay a big chunk upfront to remove mortgage insurance on a loan that they might end up refinancing in 12 or 18 months. So the monthly paid mortgage insurance is probably the only one that you're going to be directed towards or advised to do in today's current environment. That may change. If you're watching this video in 2027, talk to a trusted loan advisor about what you might want to do there. Removal of mortgage insurance is something I want to talk about because this is something that on conventional loans, it no longer applies on FHA loans. You can't remove mortgage insurance from an FHA loan. You either have to refinance and it goes away, or there's some circumstances where if you put a large enough down payment, that mortgage insurance will fall off after 11 years. But just generally speaking, know that on FHA, it's going to be stuck on the loan. On conventional, you can apply to have it removed. Most lenders want you to have it on there for at least 2 years. And then you apply and say, I've got enough equity. I've paid this down enough, or a combination of the two between appreciation and principal pay down. I'd like to apply to have this mortgage insurance removed because I only owe $375 and the house is worth $500. That they'll generally do something like a BPO, a broker's price opinion, which is a form of an appraisal that says, yep, it's worth $500. You owe $375. We're good. As of your next statement, mortgage insurance will be removed. Contact whoever's servicing the loan to remove the mortgage insurance on those conventional loans as it applies. That's generally speaking kind of what mortgage insurance is, how it works, how to remove it. Let me know what questions you have. Like most things in mortgage, it's scenario specific, right? And you really want to see the numbers for your personal scenario. What does it look like with 5% down? What does it look like with 10% down? How does that monthly payment fit into my budget? Should I continue to save and get into a loan where there's no mortgage insurance? Or can I put down 10% and have a mortgage insurance payment that's only $33 a month and get into the home I love? Eventually it'll fall off. And that happens as well sometimes, is when you get to 78% loan to value, that mortgage insurance will automatically fall off. You don't even have to apply for it. But knowing what it looks like is part of the pre-approval process, is part of the education process as you're going to, structure a mortgage, buy a house, all those things. So hopefully this was helpful. If this helped you in any way, like, comment, subscribe. I truly appreciate everybody on this channel. I'm trying to do my best to provide all the information, all the education I can so you can make better decisions around mortgage. Thanks for watching. Let me know how I can help. Let me know what else you want to see. And until next time, we gonna see.